Seems like the US banking crisis is contained once again, with 11 big banks in USA pledging $30 billion to First Republic Bank. This is a significant move to shore up confidence in the US banking system, as the individual sums of $1 billion to $5 billion in deposit are, obviously, uninsured by the FDIC. It is pretty impressive, as it should be quite obvious to anyone that the US Fed is unable to fight high inflation and to bail out the US banking system at the same time. Choosing to hike interest rate to fight inflation would increase the fallout risk in the banking system, while not hiking interest rate might result in higher inflation. The $30 billion joint deposit made to First Republic Bank did not happen because the largest banks in USA decided all at once that it was in their industry's best interest. The CEO of J.P. Morgan, the largest bank in USA, Jamie Dimon, together with Jerome Powell and the Treasury Secretary, Janet Yellen, seeded the idea. Jamie Dimon approached his peers and the $30 billion package was born. So, with the banking crisis contained once more, the Fed will be able to hike interest rate next week with one less thing to worry about. Bond yields sank for many days in a row. Because Mr. Market was betting on the Fed choosing to manage the risk of further fallout in the US banking sector rather than to continue hiking interest rate to fight inflation. There was also a flight to safety as Mr. Market moved money to the relative safety of treasuries. With the Fed likely to hike interest rate as planned, investors in Singapore should see yield on the short end of the curve rising again. So, we should see 6 months T-bill yield going higher from the relatively low cutoff yield of 3.65% per annum we saw in the 16th of March auction. As for DBS, OCBC, and UOB, I am staying invested in DBS, OCBC, and UOB for income, as I expect them to continue to bring home the bacon. With higher dividends declared, I look forward to getting bigger portions in future too. What about REITs? In the current environment, US banks are going to be more selective and risk-averse. So, I believe that it could be harder to secure loans or to refinance for some commercial properties in USA now. So, I would avoid those US REIT which have very high gearing and which need to refinance in the next 12 to 18 months. DigiCore REIT, which is a data center REIT, saw its unit price crashing because one of its largest tenants, F.I.R.E, which accounts for 22.6% of its income, has not been able to refinance a revolving credit facility that matures in November 2023. Moody's downgraded F.I.R.E's corporate family rating to junk as it believes the possibility of default over the next few months is a significant and increasing risk. Only a couple of months ago, there was a chorus of buy calls by analysts. This is why it pays to remember not to ask barbers if we need a haircut, and that no one cares more about our money than we do. Eat crusty bread with ink slowly for peace of mind.